Hello everyone and welcome to your on-chain update for the 18th of July. So over the last couple of weeks we've been talking about how, and to be fair it remains as such, keeping that bearish bias in play. And obviously those who are familiar with technical analysis and spend any time looking at the chart know that unfortunately the crypto market looks a little bit sad. Now we've caught a little bit of a bid over Sunday, but really there's a lot of work to do in order to turn this thing into a bullish trend. Now, nevertheless, I think most of us who are listening to this, I suspect, are longer-term macro bulls. So what I really want to touch on today, in the shorter term, we've really covered that the low activity is giving a bearish bias. Now, to keep that macro bullish sense, what do we need to see? And ultimately, I think that what we need to see is a supply squeeze. What we need to see is what we've seen in every single previous bull market, where we see coins being sucked out of the market, and then eventually there's nothing else that can move except price. So what I want to explore today is what that might look like, some of the early signs that we kind of have in the works, and just really explore some of those ideas on what it is that we're looking for, given everything is bearish and we're using a red slide screen to start every single one of these presentations. What will it take for us to turn this blue and then eventually green? We could start talking about more bullish price action. So a little bit of a look ahead, but also just looking at supply dynamics and how we can use on-chain tools to understand more about that. So what we're going to run through is the probabilities, or how we can really assess the notion of a supply squeeze, what it is that I'm looking for when I think about this. So we'll start by looking at relative long and short-term holdings, as that provides us an overview of what's going on in the more present moment, and also cyclical indicators and fractals as to what we've seen in the past. I also want to look at exchange balances and flows, because obviously when coins are getting sucked out of exchanges, that's a fairly direct representation of what's going on. Although I do want to stress that I certainly use exchange balances and flows as an input. I certainly don't rely on them. I'm not a huge fan personally of looking at intraday data points, and we'll actually look at a particular event here and understand a bit more about that. We're going to look at miners and hodlers. What's the balance between those two parties? And then we'll close out by running over some new check on-chain tools. So I've pushed out some price distributions, on-chain price distribution tools, and I've upgraded the HODL supply and wallet waves, and also updated we've issued the fear and greed index, which at the moment, obviously the fear part of that is front of everyone's mind. And just to jump on with the podcast recommendation. So this week, a strong recommend for the episode of Tales from the Crypt, where Marty interviews Leo Zhang, who is arguably one of the foremost experts in the mining industry. So Leo has a great deal of experience from Anika Research, great deal of experience in just understanding the logistics, the challenges, all of the components that go into the mining market in China. And really what he explains and explores is a lot of the logistical challenges. If you really want to understand the mechanics of what's going on in this great migration of hash power, really this is the best episode that I've come across, where he just discusses all the different layers of how the miners are considering the challenges, and just in terms of language barriers in order to actually ship hardware. How do you actually find suppliers and distribution units, and deal with all of the tariffs and all these different layers to it. So arguably it gives an extraordinarily detailed view on just how challenging this migration of hash power is. And what it really does is it helps us understand more about what the timeline might look like. How long is it going to take to actually complete this transition of just such an enormous undertaking? So overall, strong recommend for this podcast if you want to understand more about what's going on with the mining market in China. So let's jump into Glassnode, and we'll start our analysis. So where I want to start is on this is one of my favorite metrics in the Glassnode suite. It's a tier 3 metric, and it really is it's an all-encompassing view of the total supply. And the way that it divides it up, you've obviously got two colors here. The blue is representing long-term holders, or those older than about 5 months. The red is short-term holders, which is the other side of that. Now the dark colors are coins that are in profit, and the lighter colors are those that are in a loss. So let's just initially talk about some of the dynamics that we see across multiple of these market cycles. So I like to look at the 2015 bear market as our starting point, because really when we flow from that into the 2017 bull and then up into the 2019 and 18 phase, we can really see what's going on. So note that as we entered the 2015 bear market, we had all of our long-term holders had started liquidating. That selling pressure essentially created this downdraft in price. And then what we saw is long-term holders, or people who were accumulating 5 months before that, people who accumulated back here, their coins started to mature. And you can see that the aggregate volume of blue coins, or long-term holder coins, started to spike much higher. All right, so this is suggesting that there is accumulation going on. And then we reached this plateau, which largely existed throughout the entirety of the bear market. So this is kind of reflecting the, call it the equilibrium point, where any long-term holders who were accumulating here were being offset by other long-term holders who are going, oh, I cannot take this pain anymore. I'm selling, I'm out, I've had enough of this thing. So we reached this kind of plateau. And just before we reach the previous all-time high, so price goes through the depths of despair, we have our bear market, we hit a maximum point of long-term holder accumulation, which is roughly reaching some kind of equilibrium. In this instance, we were talking about long-term holder profit 55, long-term holder loss 20, so 75% of the total supply. And then we reach this node here, which I term peak hodl. And this is where price has now gone through the depths of the bear market. We've entered the disbelief phase, and you can see that the amount of long-term holders in profit starts to climb. This is where people start going, hang on a second, this could very well be it. This could be the rally. I'm not selling these coins, I'm going to hang on to them. Let's go. So this is where we reach the point that I call peak hodl, where we hit all-time high, right? We've come back and returned to the previous all-time high. And from that point in time, this really represents the maximum amount of profit that's in the system. The long-term holders are all in profit by definition of the all-time high. Everybody's sitting there ready to go. And then you can see that this dark blue zone starts to dip down, right? And this is the distribution phase. So phase one of the bull market is the disbelief phase, where long-term holders get more and more in profit. And then they realize, all right, here we go. We're at the old all-time high. Let's start selling and taking some profits. And as you would expect, the more that those long-term holders sell, eventually they put the top in. So there's a transfer of wealth from long-term holders in the blue, transferring to short-term holders who are weak hands, speculators, traders. They essentially sell those coins, transfer the wealth, and eventually they put the top in. So from here in 2017, we went from a 75% roughly long-term holder supply, peak hodl 75%, and they sold off down to 58%, right? So we're talking about 23% or thereabouts of the total supply was sold by those long-term holders. That's giving us a overall guide of how much demand was willing to actually take those coins off the market, right? So it gives us an idea about how much needs to be sold to actually put the top in. Now we can see something not dissimilar in 2013, albeit a little bit more complex, because we had this double pump, as some analysts call it. We had peak hodl, then we rallied up to a new peak, and they distributed some, put a top in, started reaccumulating, and then we had our second rally, and then again we moved into this phase of a bear market. So after our 2017 peak, we started to rally back higher, and you can see that we formed this similar plateau. Now note the length of time that it took. This was from 2014, late 2014, right the way through to 2017. So a multi-year bear market that eventually put the top in, noting that some of that is actually positive price maneuver. Now we had the same thing through the 2018-2019 bear. We came up, we hit a peak hodl of around 80% in this instance. So 5% more supply was locked up than in the squeeze that actually put on in 2016, 2017. We hit our 80% peak hodl range, and then the distribution started. Now, what I want you to note, let's now zoom in to our current market conditions, and we'll just explore this a bit further. So our peak hodl range, as we approach the previous all-time high, was in around 75%, which is not too dissimilar to where we were in 2017. Now remember that we sold down. When we put the top in 2017, we hit a low, a long-term holder low of 58%. We sold down and we got to 67%, 67.6, let's just say 68% for simplicity. So we're talking about 10% more supply is held by long-term holders. We're coming from a much higher base than where we were in 2017. So remember, in order to get a supply squeeze, previously we had somewhere between 75 and 80% of the supply that was held by long-term holders. To put the top in, we only sold 10%, we sold 10% less. And that, bear in mind, that's after 4 years of freshly mined coins. Okay, so we were able to put the top in with less coins distributed, but there's also more actual coins for that same percentage, right? So it does make sense that there's an offsetting of that volume in there. And that would have been, again, during the third halving epoch, there's issuing quite a few coins, 1,800 a day. So when we think about where we're at the moment, we're coming from a higher base, 68%, sorry, and you can see how rapidly this is actually rising. We've currently risen up to 70% on the profitable side and 5% on the long-term, on the loss side. So what that actually means is that we're at 75%, which is where we were back in before the 2016 rally. So the 2016 level, 75%, is approximately where we're at the moment in terms of long-term holder. Call it supply locked, for want of a different analogy. So we're actually starting to look a little bit like that 75 to 80% range of supply that creates the supply squeeze in previous cycles. So this is where I start thinking, okay, sure. Bear in mind that this took some time for the supply squeeze to actually play out. And really the question really come from what happens when we get volatility from here on. Do we get long-term holders that sell? Or do we get long-term holders that go, you know what, I actually think this thing is going to continue to rally, and I do believe in the macro position of Bitcoin, which I think is actually the more probable scenario. But again, we will be able to see what happens when we get a price rally or a sell-off, where the long-term holders actually start distributing and our lifespan metrics tick higher. But at the moment, I do just want to highlight that an early stage of what this might look like as a supply squeeze, it is very possible that this could start to look something more like that 2013 rally, where we get this double rallying or a double pump type system. Maybe the whole cycle thesis is completely out the window, which is more along the lines of where I tend to like to look at the supply dynamics and base my decisions off that, rather than thinking about some cycle that it needs to fit the mold. But what I really want to highlight is 75 to 80% is the amount of supply locked that generated a squeeze in previous cycles, right? The initiation of the bull market following the disbelief rally. We are currently at 75%, and within short order, if we think about how much supply is being held by these long-term holders, that's continuing to grow. So it's possible that we could hit the 80% level, perhaps in 1 to 2 months. Now, what happens if we start to progress beyond that? Do we start talking about there's a real potential for a supply squeeze here? This is certainly something that I'm paying attention to. So I have a dashboard here that I've aptly named Supply Squeeze. We've just covered the long-term holder, short-term holder profit and loss. That's really the metric that I think paints the picture of what a supply squeeze would look like. Now, in order to see that, we basically want to see people hanging onto their coins. Now, we've mentioned in previous videos that we've got this downtrend in these younger hodl waves, which is even more amplified on the realized cap hodl waves. Really, the realized cap hodl waves is kind of an exaggerated version of the hodl waves themselves. The hodl waves is an explicit how many coins in the total supply are at different ages, which is why we can see these 10 years and 7 to 10 years, because there's a lot of them, right? Satoshi's coins are very old, but really when Satoshi mined them, they didn't have a price. When many of the early miners 7 years ago were mining, they had cents to $1, right? There was no price. And that's why the realized cap hodl waves represents how much dollar value, since they last transacted, how much dollar value do those coins hold, right? If they're spent, they will realize a whole lot of dollar value, and they'll be revalued from 6 cents to $32,000. So what we can see here is that the volume of these red zones, the younger coins, during a bullish pump, when you get old hands that are spending their coins, that wealth is transferring to the new hands. Now what we're seeing is the opposite. We're seeing those coins maturing. There's less dollar value being held in these younger coins, and that's because they're moving from 1 day to 1 week to 1 month and so on and so forth. And we can see the swelling out of these 3 to 6 month and 6 to 12 month type bands. We're starting to even see it on the total supply. You can see that the 6 to 12 month is really starting to bell out and swell. This is good to see. This is telling us that there is a potential supply squeeze happening here. Now, when we look at liveliness, and I do just want to highlight this one little jump here. We'll see this on a number of metrics. You can see it on our Coindays Destroyed 90. I want to touch on that. That's what I think is an anomaly, but we'll touch on that in a second. So just ignore that for now. We'll talk about the rest of the trend. So liveliness and Coindays Destroyed 90 are both very macro views. Liveliness is a very, very big metric. It's the container ship of lifespan metrics. What it looks at is every single coin in the system, it accumulates 1 coin day. Now, some of those coins get spent. So for every 1 BTC that's stationary, it's accumulating 1 coin day. Now, if that BTC is spent, it's destroyed that coin day. So what liveliness does, it looks at every single day, how many coin days were destroyed, how many coin days were accumulated, and what's the ratio between the two as a cumulative sum across the entirety of Bitcoin's lifespan. So the way we interpret this is when it's trending down, it means that there's more coin days being accumulated by the network, there's more dormancy in the system than is being destroyed. So generally, it signifies hodling. So we see this in a bear market, we get this structural downtrend in liveliness. More coin days are being accumulated by the network than are being destroyed. During a bullish impulse higher, we get these steep curves where it's a massive amount of coin days are being destroyed, more than are being hodled. Then it starts to slow down, slowing down, and now we've actually reverted back into a downtrend. So this is really confirming that overall the network is currently very dormant, which you would also notice if you looked at the mempool, right? Very, very quiet, very low on-chain volume. Coindays 90 is basically the sum of all coin days destroyed over the last 90 days. Naturally, when older coins are spent, this will trend higher. When younger coins are spent, it won't. This is a structural downtrend, very much aligning with this slowdown in liveliness, a structural downtrend, which is now actually down into the bearish zone for coin days destroyed. What this is telling us is the old hands are just not selling. They're just not spending their coins, and it's starting to say maybe there's a supply squeeze somewhere just over the horizon, something to be paying attention to. Long-term holder net position change and our illiquid supply change are telling us something very similar. You can see that this is really coins that were accumulated 5 months ago, which is disproportionately in February and January. That's kind of the range. I think we've actually passed out of January now. We're talking about the February zone. So really, we're talking about coins that are actually now underwater. And we can see this in our relative, you can see this holders at a loss. We're currently sitting at 6% of long-term holders are currently holding coins that are underwater. A lot of those, what we really want to see is this continue to trend higher and hold that level. That's going to be telling us that those coins remain dormant. Now you can see that this metric in particular is starting to flatten out. Perhaps if this starts to revert, now we're starting to get into the territory where we're going to start seeing the coins that bought in February or bought in March and maybe didn't hold on to them. Conversely, we may see a whole lot of those coins that did get held onto. So what I think is going to happen, and actually let's just take back to another analogy here. Let's go back to our relative short squeeze. Note how the reason we get this lengthening of these cycles here, and sometimes we get a dip, then we squeeze back up, then we get a dip. This is uncertainty, right? These are long-term holders who go, no, that's it, I'm shaken out. I don't like price action, whatever reason, I need to pay the bills, whatever it is. This is why this may not necessarily just be a straight vertical up and then squeeze, away we go. We may get some time and volatility as the coins that came into February and March and April, and we know factually that a lot of those coins sold. So we may get some lengthening and some chop before we finally get this supply squeeze. It all sits around 75, 80%, but it takes time because some of those coins are still being spent. So really, it's going to come down to a test of conviction to see how quickly this plays out. And we'll start seeing it in this long-term holder net position change and the illiquid supply change. Now, our miners, you can see that our whale balances, number of entities with a balance greater than 1K, this is starting to flatten out. So at the very least, we're seeing this not selling down, right? This is clearly selling down. We're starting to flatten out. This is a positive sign. We want to see this. We're looking for what are the symptoms or the signs and signals that would say a supply squeeze is probable. And what we're seeing at the moment is it's actually looking okay. It's actually looking fairly promising. Now, when it happens, whole different ballgame. But what we're seeing is early signs that it's time to pay attention to it. And simultaneously, if something changes, then we can start to get concerned. If we start seeing all these metrics reversing pretty hard, lifespan ticks up, all these types of metrics kick in, time to start getting a little bit more concerned that maybe we do have a more prolonged, protracted bear market in play. And so our miner net position change, what's nice to see is that this has actually gone green. Now, a lot of miners, I believe the next difficulty adjustment is coming up. It should be actually within the next couple of hours, I think. Now, what that's going to do is it's going to put the whole network back into equilibrium. We saw the largest difficulty adjustment 2 weeks ago. This one, I believe, is going to be down about 10% or 9%, last I checked. And I think that's going to put the network back into equilibrium. And because it's a downwards adjustment, miners who are currently operational are going to be printing money. So short of miners in China who really just get absolutely burnt with these logistical costs, which again, that podcast gives you a lot of insight into what those look like. At the moment, the miner net position change is actually saying pretty good, right? It's actually a positive sign. Whatever is being sold from treasuries by distressed miners in China is being offset by the immense profitability and not selling by operational miners. Now, onto our exchange flows. Now, we've seen this little blip show up on a number of things, and you can see it pretty clearly here on the Volume 2 exchanges. Now, what happened the other day is there was some 2017 coins that were spent and sent to Coinbase. Now we can see here's our balance on Coinbase. You can see the dramatic uplift in this, and our balance on exchanges to Binance, which is the other major inflow. These are basically the big two in terms of coin holdings, has started to flatten out. There's obviously some regulatory risk going on with Binance. They're kind of copping heat from all angles, so that's something to be paying attention to. But just note how these 2017 coins increased our balance on exchanges. They also showed up, where are we, on our liveliness. This shows the magnitude, right? Because the 2017 coins, I think it was about $1 billion worth, 32,000 coins or thereabouts. Now they've essentially destroyed 32,000 coin days per coin, multiplied by however many days it is between today and when they were accumulated back in 2017. So there's a lot of coin days accumulated in that. So that's what these vertical moves are. It's a huge expenditure of coin days. We can see it on this metric here. I mean, it basically shows up across the board, but you can see that these anomalies could potentially, if you didn't realize that it's a single event, it's not necessarily a trend change yet. It shows that there was a single event that sent those coins into an exchange. Now, whether they're actually going in for custody, whether that $1 billion is there for sale, we'll have to wait and see. I'm personally not a huge fan of taking that data point and saying, that's it, chuck it in, it's over, $1 billion, we're going to sell. I'm not a huge fan of using single data points, particularly with exchange metrics. I tend to like to see a trend forming, and until this really resolves itself, give it a couple of weeks for the data to get reprocessed and rechecked and all this kind of thing. I'm not a huge fan of reacting to single data points. I like trends, so we'll see what happens with this over the next couple of days. But what we have seen, with that aside, we have seen this kind of flattening out and starting to get a bit of a downtrend in exchange balances. We've seen more outflows than inflows. Granted, the mempool is still very quiet, so that's something to pay attention to. Our exchange net position is actually moving back into the red. Now you can see it's not exactly what we saw in the supply squeeze zone, 20,000 previously, but what we are starting to see is a continued trend down, right? We're not seeing inflows. It's now reversed that course and is starting to increase. So this is what we do want to see. So that's kind of a bit of an overview on the supply squeeze probabilities and metrics. It's just something to be paying attention to. I'm certainly not of the opinion that we're suddenly going to rally to all-time high. I think we do have some work to do. Maybe we again need to take lower prices, right? That could very well be the possibility. We're still tiptoeing around this 60-40, 50-50 type split. It really could go either way at the moment. But this is certainly something that I'm paying attention to in the moderate term, right? We're talking about 2-3 months away. Something like this could very well start coming to fruition. And at the very least now, we've got some models and metrics that we can pay attention to, that what would trigger a squeeze and what would trigger us to go, okay, this is not happening. If we start getting all of these metrics reverse course, then the supply squeeze is off, and prepare for a more longer protracted bear market. So let's jump across to check on chain. So under our cycle metrics, these are some of our newest new additions that Permal Nino and I have pushed out. One of them that's pretty useful is the Fear and Greed Index. So a lot of people have looked at the alternate.me Fear and Greed Index. What we've essentially done is pulled their API and brought this thing into a nice little oscillator. So we can start seeing how fear and greed in the market, which includes things like volatility, it includes things like Twitter mentions and bearish posts, and just a whole bunch of things that go into the algorithm, and give us a bit of an indication on what's going on. Now we can see that we've basically been in the fear zone for some time. I think we recorded a value of 15, which realistically, I mean, we're talking about some pretty dark times, right? Back here in 2018, we had a similar zone in the pit of the bear market. Now note that what is low can continue to go lower. So even though we've got fear in the market, it's fairly short relative to a full-scale bear market. Very similar to what we saw in in March 2020. Sorry, so you can get these longer periods of protracted. But you see how volatile this all is. This was this is obviously just deep dark. Everybody thinks it's going to zero at this point in time. That's kind of what you want to see for a bottom. You want to see a protracted period of time where it's trading at single-digit values. That's real doom. So we've certainly been toying with some of these lower values. Note how the El Salvador rally really lifted things up, and we are still languishing down here, which overall is actually not a bad sign, right? You want fear in the market. I still am not quite sure whether we're sitting up here in 2018 or whether we're down here in February 2019. Which of these two models is more likely? I do think that if we do get a squeeze to the upside, the FOMO will be pretty real. I think people will recognize, oh wow, this thing is, I thought it was dead and doomed, and all my bids down there at 20,000 or 10,000, I'm seeing people calling at the moment. All my bids didn't get filled. I guess this thing is just going to collapse down. I'll just wait. That FOMO can be very powerful as well. So I think that whichever direction we go, it's probably going to have some gusto when it actually goes. So that's our fear and greed index. We've also recently updated a few things, actually. We've got our supply distribution bands, and we've got in all of these supply distribution as a proportion of total supply, or just as volume. So in terms of proportion of total supply, this is basically showing for all of different wallet categories within 10,000 to 100,000, 1,000 to 10,000, how much of the proportion of the coin supply is held. So we can see here it's basically varying from 0% to 1%. So it's kind of similar to the hodl waves, but obviously with address balances. So this is showing basically the balance waves. And we've then got another model which maps it out, so you can actually see it as a proportion of the total coin supply. So that's what we have when we've got our, as a percentage of supplies between 0 and 100%. And volume is then mapping it to into the actual supply curve, so we can see what's going on. We've also got our hodl waves, so you can see our hodl waves. Now, again, here's our coin maturation. You can see that we've got these younger bands are really starting to decline quite substantially. We're getting this nice belling out of our 6 month to 1 year, which is excellent to see. That's really what we do want to see. We still have quite a lot of supply. You can actually see up here, this is our 3 to 5 year or 3 to 4 year band starting to really expand. Now, these are buyers from back here in 2017, these 3 to 4 years, and 2018. So these are people who've stuck through some serious volatility, and it's actually really good to see them holding onto their coins. So it's kind of demonstrating that macro asset behavior of what Bitcoin has become, stepping onto the geopolitical stage. People have a lot of conviction to hold this thing. So overall, we're seeing a lot of positive signs across our hodl waves, which is good to see. And then we also have our address count. So this is basically mapping out as a proportion of the number of how many addresses there are. So when we look at the proportion of all addresses in the market, how many of them are holding 0.001. So basically what we see is the inverse Pareto distribution. So the largest number of holders, where's our relative supply held? So note here that the purple colors are 100,000, 10,000, 1,000, and they're pretty much holding, I mean, here's 40%, so that's 60% of the supply held by people with more than 100 coins, right, in a single address. So the 60% of the coin supply is held in those addresses, noting that exchanges are included in that, and they're going to have lots of customers and, all those intricacies. Now, when we compare that to the number of addresses, the address count, notice how our 100,000, 10,000, they've disappeared into this tiny little band at the top here. It's kind of that reverse Pareto distribution. So the maximum number of coins are held by a small number of wallets. And conversely, very, very small holdings, less than a couple $100, they have 51% or 50% of the entire UTXO set are holding less than $100 worth of BTC. So it gives you a bit of a scale on how much is actually held by these different parties, and just the different distribution between these different sets. And one thing we can see here is so this will actually show us our total UTXO count. So because, addresses and UTXOs are fairly similar in their total construction. So let's zoom into our recent period. Now, one thing that I did notice, which I actually find to be fairly informative at the very least, note our 2017, we got a parabola in the amount of people accumulating UTXOs. The amount of addresses also went parabolic with price. Now, what happened after that blow off top? A whole stack of people liquidated, right? A whole stack of people got out, and we saw this collapse in UTXOs, and then it basically had a prolonged bear market. After the capitulation, we started rallying again, right? So people started accumulating and creating address activity. Now, we had a very slight reduction in the total number of UTXOs in the market, but really nothing of this scale. We didn't see a mass exit where addresses just spending their whole balance. This basically has traded sideways. So this is telling me a lot about the accumulation behavior. I just think that that's a very interesting, unique data point where, and again, there's only 2 data points we can really look at here, but we saw a mass flush in 2017 where people just, that's it, I'm done, this thing, in absolute disgust. Note that it's after the peak too, right? This happened on the flush down on this relief rally. People just go, that's it, I'm out. I can't deal with this bear market. I've just seen, 50-60% of my value disappear, and I don't want to deal with this anymore. We have not seen that this rally. We're seeing a stabilization of the UTXO set. People are just not liquidating everything, and that's really, again, supply squeeze is becoming more and more likely when I look at these metrics. And I've also included here a supply dynamics chart, which is basically just mapping out. Whoop, hang on, nope, that's my wrong chart. Let me just find that one. Here we are. So the supply dynamics, what I've done is broken up the Bitcoin supply. We've got 4 different metrics here. Our circulating up here in green, so that's obviously the total coin supply. Coin Metrics has a metric called the free float supply, where they correct for all of Satoshi's lost coins. It's basically factoring out coins that we reasonably assume are lost. And you can see here that we're at 14.6 million coins or thereabouts, which, we're basically talking about we've lost 4 million coins in total. So it gives you a bit of a scale on what the actual coin supply is in terms of ones that aren't lost. We've also got here our supply that's active in the last year. And you can see we get these bullish impulses where more coins come back to life. Then we get a bearish market where things go back to being quiet. And we get this nice oscillatory behavior. So you can also see that the amount of coins that came back to life was nowhere near what we had in the 2017 peak. Arguably, it's quite similar to what we had in the 2013, 2014 bear. So, there is precedent for being at that level in terms of the amount of coins that were dormant and then liquidated and sold. And at higher prices, you need more dollars to come in and absorb that. And then we also have down here the miner unspent supply. So how many coins are owned by miners that were in the Coinbase transaction that have basically never been spent? And you can see that's not a trivial sum, right? This includes Satoshi's coins. But 2.8 million coins are essentially unspent by miners, and a good chunk of those are probably going to be lost. So that, it gives us a bit of a scale on how much actual free float supply is circulating in the system. And just to close out in our realized value section, we've got 2 new models. One is the realized volume profile in USD and another one in BTC, so USD and BTC. So what these are is not dissimilar to the UTXO realized price distribution. It's kind of like a volume profile. Shows you whereabouts the amount of transacted volume is on a closing daily basis. And it's essentially showing us 2 things. One, where we are at the moment in the 32K range is a very, very large supply cluster. We've seen a huge amount of coins that were purchased up in the $50,000 range, get repriced down here in the $30,000 range. So there is a lot of on-chain support here. The flip side to this is the unfortunate reality that there's very, very little sitting underneath us. So we do have to just be very careful that if we do get a sell-off, it could move pretty angrily. And next support is essentially the previous all-time high at 20,000. So it could be a quick rally down. It could be that people front run in some of these mid-20 ranges, but it's certainly a risk to be aware of. But you can see the scale of how many coins have moved here. So there's a lot of people with a cost basis here. The question is that going to become overhead resistance if we lose this level? That would certainly be something that we're looking for, and probably put the supply squeeze in inverted commas. It would put that on hold if we lost this level, and then we see people just going, that's it, I'm out, liquidating their coins, flooding exchanges. That wouldn't be a good sign. And we've also got a similar metric for priced in, so that's in US dollars. This guy here is priced in BTC. So this is on a log scale, and it's basically priced in. You can see how these different volume clusters in BTC that's moved. Now, the reason that I've got these 2 different charts, because if you price coins in US dollars, if you do it in BTC on a linear scale, as you can imagine, for the first 12 years of Bitcoin's life, we were underneath 20K. And a stack of coins were moving at very little price, right? Miners back in the day were sending 50 BTC and spending 2 BTC on fees. Like, they were worth nothing. So you get just a huge amount of volume up here, and the chart doesn't make any sense. So this is on a linear scale, priced in US dollars, and gives us probably the most accurate for where we're currently at. If we look at the current price, what's the volume gap in and around? So short term, what's going to happen in the next couple of months? If we then look at the BTC range, this gives us a more historical view. So now we can start comparing how big a range is in terms of coins moved, bearing in mind that coins get increasingly lost and locked up, and $100 used to be 50 BTC, and now it's 0.0003 or whatever it is. So we're going to have these different dynamics in play. So it's more of a historical comparison, but on a BTC basis. And within that, you can see that our volume cluster at the moment is fairly similar to what we had up in 50,000. There's going to be a lot of transferred coins that moved from this 55 down to this 30 range. But again, you can see the gap between here and 20,000. Here's our 20. There's not much. There really isn't much in BTC volume. It just moved too quickly. So in terms of support, aside from some probabilistic knife catching, realistically, just be aware that there is a 50% haircut risk before we get to the next major support level. I've mentioned before, I think that's going to get bought, right? I think people are going to step into that, but it's also a major risk, right? And then what happens with the overhead supply of people who've accumulated at 30,000? Are they going to hold strong? So that's a bit of a summary. Thanks for tuning in for this one. There's a lot going on. I'm aware that the supply squeeze is one of these things that a lot of people are going to be, bullish. Engagement farming is high on the agenda. People love it. Be aware that we're not necessarily showing huge activity on chain. The nature of a supply squeeze is the reality of a bear market. They're kind of one and the same. So it's going to take time, I think, for this to all get absorbed, the supply to get taken in. We're seeing good signs, right? We're seeing old hands not spending. That's positive. We're seeing the supply at 75% by long-term holders. That's positive. And what we want to see is the next volatile move, up or down. We want to see both of those trends remain intact. No spending and continued hodling, right? They're one and the same. So we want to see that on the next volatile move. What we don't want to see is the exact opposite of that. We don't want to see miners get stressed and start liquidating. We don't want to see people who bought at 30,000 go, that's it, I'm out. We don't want to see all of these coins that are currently maturing go, that's it, this macro asset is dead. That would flood exchanges with even more coins. And really, it's probably the worst thing that we could see. Plus, we've got this enormous volume profile gap down to 20,000. So it's going to get reflexive and it's going to move with some gusto. I think there's a lot more headwinds to the upside than the downside. But I think on the macro scale, if this supply squeeze keeps going, I think the bears are underestimating how powerful that could be and how close we are to it. So that's really the summary, is that I think the bears are underestimating that squeeze. And I think the bulls are overestimating how quickly it's going to show up. So thanks for tuning in. As always, you can grab me in chat rooms and comments, and I'll get back to you as soon as I can. Cheers.